You think the global economy is improving and your hard-earned cash is safe inside your retirement account. But the harsh reality is you are quietly being set up as the ultimate exit liquidity for billionaires. Comment your current age and the exact dollar amount you invest every single month right now, because this hidden financial mechanism is going to affect your money whether you like it or not. Elon Musk is preparing the largest initial public offering in human history, with SpaceX targeting a staggering $1.75 trillion valuation, which is worth more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all put together. But behind the hype of rockets and Mars missions, the consolidated entity actually lost nearly $5 billion last year after absorbing XAI, which is currently burning over $1 billion every single month. So who is going to buy a company losing $5 billion annually at the highest valuation in human history? The answer is you, because Nasdaq quietly introduced a brand new fast entry rule that cuts the seasoning waiting period from 3 months to just 15 trading days, while completely eliminating the 10% minimum free float requirement to roll out the red carpet for Elon Musk. This means index funds and ETFs tracking the Nasdaq 100 will be legally forced to automatically purchase SpaceX stock, using your retirement money within weeks of the listing. Ordinary retail investors are being targeted to absorb 30% of this massive IPO supply under the guise of loyalty, when in reality Wall Street is just dumping overpriced shares onto passive accounts. If you want to achieve true financial freedom and avoid getting absolutely crushed in the market, you must stop chasing hyped IPOs and stop trying to time the market, because time in the market always beats timing the market. The smartest financial decision you can make today is to ignore the noise and commit to a disciplined long-term strategy by automating your wealth accumulation. Look at real practical wealth-building tools, like opening a Roth IRA or an individual brokerage account and consistently dollar-cost averaging into broad market index funds, like VOO, which tracks the SP 500, or solid dividend growth funds like SAG. Standard passive investing works beautifully when you stay disciplined, but you must understand that the exact same mechanism that makes index investing convenient also forces the index to buy whatever junk gets squeezed into it. To counter this systematic risk, you need to maximize your personal savings rate by aggressively cutting down your lifestyle inflation. Stop financing $70,000 electric vehicles just to look rich, and instead choose to drive a reliable 2006 used car while living in a minimalist space until your investments generate real passive cash flow. Building true wealth is not about buying into the latest trillion-dollar hype train, but about consistency, discipline, and holding assets for decades. Let us break down exactly how this financial machine operates, because understanding the plumbing of Wall Street is the only way an ordinary person can avoid getting completely destroyed by the elite. Look at how the entire system has shifted over the past decade toward passive index investing, which was originally sold to the public as the ultimate democratic financial tool. You were told that if you just put your money into an index fund that tracks the top companies, you would beat 90% of professional stock pickers over the long run. And that advice is statistically true, but it contains a massive structural blind spot that big institutions are now weaponizing against your savings. When you buy a standard mutual fund or exchange-traded fund that tracks a major index like the Nasdaq 100 or the SP 500, you are not choosing individual companies based on their balance sheets or profit margins. Instead, you are trusting an automated algorithm that buys shares of companies simply because they exist in that specific index, and they are weighted based on their total market capitalization. This means the bigger a company gets, the more the index fund is legally required to buy, regardless of whether that company is actually making money or burning cash, like an open furnace. This automated buying pressure creates what economists call manufactured demand, where billions of dollars from ordinary 401k plans and retirement accounts flow into a stock automatically, just because it crossed a certain threshold. Now enter Elon Musk and the strategic restructuring of his entire corporate empire to perfectly exploit this exact mechanism at a scale humanity has never seen before. SpaceX was historically a pure aerospace and defense contractor focused on building reusable rockets and securing lucrative government contracts from NASA and the Pentagon. That core rocket business is highly impressive from a technological standpoint, but it generated only about $4 billion in revenue last year, which is an incredibly small number when you try to justify a $1.75 trillion valuation. Then you have Starlink, which is the true crown jewel of the operation and functions essentially as a global satellite internet provider with over 10 million active subscribers across 150 countries. Starlink is a phenomenal business that brought in $11.4 billion in revenue for 2025, with profit margins rapidly expanding from 41% to 63% in just 2 years. If SpaceX was just the rocket business and Starlink, it would be an incredible enterprise. But the situation became incredibly messy in February when SpaceX acquired xAI, which is Elon Musk's personal artificial intelligence laboratory, in an all-stock deal that valued xAI at $250 billion. This artificial intelligence startup was originally founded with 11 brilliant co-founders from places like DeepMind and Google, but by the beginning of this year, every single one of those co-founders had left the company, and it was burning over $1 billion of cash every single month. When you combine a cash printing satellite internet business with a massive artificial intelligence operation that burns cash faster than it can be generated, you get a consolidated company that ended up losing nearly $5 billion last year on $18.5 billion of total revenue. Under normal market conditions, an unprofitable conglomerate losing $5 billion a year would face extreme scrutiny from institutional investors during an initial public offering, and the market would take months or even years to properly discover its true valuation. But Wall Street and the major stock exchanges decided to completely rewrite the rules of the game right before this historic listing took place. On May 1st, Nasdaq quietly implemented the fast entry rule, which completely shatters the traditional protections that were built into the financial system to protect public investors. Under the old framework, a newly public company had to wait a minimum of 3 months before it could even be considered for inclusion in the prestigious Nasdaq 100 index. This 3-month seasoning period was absolutely critical because it allowed short sellers, analysts, and independent researchers to trade the stock, openly discover its real fair market value, and shake out any artificial hype before passive index funds were forced to buy in. The new fast entry rule compresses that entire 3-month price discovery window down to just 15 trading days, which means passive index funds will be legally forced to flood the stock with billions of dollars of automated buying pressure before the market even has a chance to figure out if the company is actually worth the valuation. Furthermore, the regulators completely eliminated the long-standing 10% minimum free float requirement, which used to dictate that at least 10% of a company's shares must be available for the public to trade openly. SpaceX is intentionally targeting a tiny free float of only 4 to 5%, which means the vast majority of the shares will remain locked up in the hands of insiders and early investors, while a microscopic amount of shares will actually be traded on the open exchange. Under the previous rules, this tiny float would have resulted in an automatic disqualification from entering the index. But now SpaceX qualifies perfectly. To make matters even more insane, buried deep within the technical jargon of the new regulations is a hidden multiplier rule for companies with a public float under 20%, where Nasdaq will artificially treat the float as if it were 3 times larger than it actually is for weighting purposes. This means a 4% public float will be treated by the index algorithms as if it were a 12% float, forcing passive exchange-traded funds to purchase 3 times more shares than they naturally would have under normal math. What you are witnessing is the total engineering of artificial demand designed to roll out a red carpet for an unprofitable trillion-dollar company so that insiders can achieve maximum valuation on their shares. And who is the CFO targeting to absorb the rest of this massive offering on the open market? The retail investor is being allocated an unprecedented 30% of the initial public offering, which is significantly higher than the standard 5 to 10% allocation found in typical listings. The executives tell the media that this is an act of generosity to reward loyal fans of Elon Musk, but anyone who understands how corporate finance works knows that this is simply dumping massive supply onto retail buyers who trade on emotion rather than fundamental cash flow analysis. When the insiders want to cash out, they need a massive ocean of buyers to absorb their shares without driving the price down to zero, and your retirement account, along with millions of emotional retail investors, is providing that exact exit liquidity. This is why you must wake up and realize that the traditional financial narrative of chasing individual hot stocks or trying to ride the wave of massive initial public offerings is a dangerous game where the house always wins. If you want to protect your hard-earned capital and build true lasting wealth that allows you to walk away from corporate slavery, you must adopt a completely different philosophy grounded in relentless discipline, long-term consistency, and extreme lifestyle control. Stop looking at the stock market as a casino where you try to hit a home run on the next big technology trend and start looking at it as an automated wealth-building machine that requires zero emotion and absolute adherence to strict personal rules. The absolute foundation of real wealth accumulation for an ordinary person is the mastery of the savings rate, which is a metric that most people completely ignore while they stress out over daily stock market charts. Your savings rate is the absolute percentage of your income that you keep and convert into productive assets every single month, rather than spending it on depreciating liabilities that serve only to impress people you do not even like. If you are making $5,000 a month and spending $4,800 of it on premium apartment rentals, subscription services, dining out, and financing a brand new luxury vehicle, you are operating with a microscopic savings rate that guarantees you will remain trapped on the financial treadmill. For the rest of your productive life, to break free from this cycle, you need to aggressively attack your largest fixed expenses, which are traditionally housing and transportation. Look closely at the choices you are making in your daily life and ask yourself if you are sacrificing your future financial freedom just to maintain a temporary illusion of wealth in the present. Instead of falling into the trap of lifestyle inflation, where every single raise or bonus you receive is immediately swallowed up by a higher rent or a more expensive car payment you must choose to live far below your means. This means making radical unconventional choices like driving a reliable older used car from 2006 that is fully paid for in cash rather than locking yourself into a $70,000 electric vehicle loan that drains hundreds of dollars from your pocket every month in principal interest and insurance premiums. It means adopting a minimalist mindset toward your living arrangements, perhaps choosing a simple functional space with zero unnecessary luxury amenities so that you can redirect thousands of dollars every month into your investment accounts. Once you have maximized your personal savings rate and engineered a massive gap between what you earn and what you spend, the next critical step is to automate your investment strategy using highly efficient, low-cost financial tools. You must stop trying to time the market by waiting for the perfect correction or trying to guess which week the market will hit a bottom, because decades of financial data prove conclusively that time in the market always beats trying to time the market. The human brain is structurally unsuited for market timing because emotion, greed, and fear will inevitably cause you to buy at the absolute peak of a hype cycle and sell at the absolute bottom of a panic. The antidote to this human weakness is dollar cost averaging, which is the disciplined practice of investing a fixed dollar amount into the market at regular intervals, regardless of whether the market is up, down, or moving sideways. When you dollar cost average, you automatically buy fewer shares when prices are high and significantly more shares when prices are low, effectively turning market volatility into your greatest long-term advantage. To execute this strategy effectively, you should utilize tax-advantaged accounts like a Roth IRA, which allows your investments to grow completely tax-free and allows you to withdraw your wealth in retirement without paying a single penny to the government. Within these investment accounts, you should completely ignore individual hype stocks and focus your capital on broad market index funds like VOO, which gives you instant diversification across the 500 largest and most profitable corporations in the United States. By owning a fund like VOO, you are backing the entire American economy and ensuring that your wealth grows in tandem with human productivity rather than depending on the success or failure of a single unpredictable chief executive officer. If you prefer a strategy focused on cash flow and dividend growth, you can allocate a portion of your capital to a high-quality dividend exchange-traded fund like SHD, which holds a diversified portfolio of financially stable companies with a long history of consistently increasing their dividend payouts. When you combine a high savings rate with consistent dollar cost averaging into funds like VO and SHD inside a tax-sheltered account like a Roth IRA, you create an unstoppable compounding machine that will inevitably deliver true financial freedom over time. The beauty of this approach lies in its absolute simplicity and its reliance on mathematical certainty rather than speculative luck. You do not need to read financial news every morning, you do not need to worry about what Nasdaq rules are being changed behind closed doors, and you do not need to care about the valuation of the latest high-profile initial public offering because your wealth is anchored to the broader productivity of the entire economic system. Building wealth is fundamentally a psychological battle against your own impulses and the nonstop marketing machine of consumer capitalism that wants you to spend every dollar you earn. The system is designed to keep you broke dependent and working a job you hate so that you can continue to buy things you do not need to impress a society that does not care about you. True financial freedom is the ultimate form of rebellion because it gives you total control over your most valuable asset, which is your time. When your investments generate enough passive income to cover your basic living expenses, you are no longer forced to trade your time for a paycheck, and you can choose how to live your life on your own terms. Stop being the exit liquidity for the financial elite. Stop participating in the hyped casino of speculative investing and start building a real foundational fortress of wealth through discipline, consistency, and long-term commitment. Focus on your savings rate, automate your investments, ignore the daily noise of the media, and let time do the heavy lifting for your portfolio. Hit that subscribe button. Peace.